Have you ever wondered how some people seem to build wealth without being stock market geniuses or crypto wizards? What if I told you there's a surprisingly simple, almost boring way that has been quietly making people rich for decades? Today, we're pulling back the curtain on one of the most powerful wealth-building tools you've probably heard of but might not fully understand, the S&P 500. Forget trying to pick the next big stock or timing the market perfectly. We're going to break down how investing in the S&P 500 isn't just for Wall Street experts, but for anyone who wants to see their money grow over time. This isn't a get-rich-quick scheme, it's a get-rich-surely strategy. So grab a coffee, get comfortable, and let's dive into how you can put America's top 500 companies to work for you. First things first, what exactly is the S&P 500? Imagine you could own a tiny slice of the 500 largest and most influential publicly traded companies in the United States. We're talking about household names like Apple, Microsoft, Amazon, and Google. The S&P 500 is an index, basically a list, that tracks the performance of all these companies combined. When you invest in an S&P 500 index fund or ETF, you're not just betting on one company, you're betting on the overall health and growth of the entire U.S. economy. This is the magic of diversification, built right in. If one company has a bad year, there are 499 others to help balance things out. It's like having an all-star team working for your financial future. So, how does this actually make you money? It comes down to two powerful forces: capital appreciation and dividends. Capital appreciation is simple, as these major companies innovate, sell more products, and become more profitable. Their stock prices tend to rise, since your investment tracks all 500 of them. The value of your shares goes up too. Over the long term, despite the ups and downs you see on the news, the S&P 500 has a consistent track record of heading upwards. Historically, it has returned an average of about 10% per year. That's a powerful growth engine for your money. But that's not all. The second way you get paid is through dividends. Many of these big, stable companies are so profitable that they share a portion of their earnings with their shareholders. That's a dividend. When you own an S&P 500 fund, you collect these dividends from hundreds of companies. Now, here's where it gets really exciting. You can choose to take these dividends as cash, or you can do something far more powerful: reinvest them. Reinvesting your dividends means you use that money to buy even more shares of the fund. More shares mean you'll earn even more dividends in the future, which then buy even more shares. This is the snowball effect we call compound interest, and Albert Einstein supposedly called it the eighth wonder of the world. It's how a small, consistent investment can grow into a massive nest egg over time without you lifting a finger. Let's look at a real-world example to see this compounding magic in action. Imagine you started investing just $300 a month into an S&P 500 index fund 30 years ago. Let's assume you got that historical average return of 10% per year. You would have invested a total of $108,000 over those 3 decades. Seems like a lot, right? But what would it be worth today? Brace yourself. Now, I know what some of you might be thinking. But the stock market is risky. What about crashes? And you're right to be cautious. The market does go down. We've seen it happen time and time again. But here's the key: history has shown us that for every downturn, there has been a recovery and a new high. The S&P 500 has weathered world wars, economic recessions, and global crises, and it has always bounced back stronger. The trick is to not panic. When the market drops, nervous investors sell, often locking in their losses. But savvy investors see these downturns as a buying opportunity. When you invest consistently, month after month, you practice something called dollar cost averaging. When prices are low, your fixed dollar amount buys more shares. When prices are high, it buys fewer. Over time, this strategy smooths out your purchase price and can actually boost your returns. The mindset is crucial. You are not a short-term trader. You are a long-term owner of a piece of American business. So, How do you actually get started? It's easier than ever. You don't need a fancy financial advisor or a huge pile of cash. You can open an account with a low-cost brokerage firm online. Think Fidelity, Vanguard, or Charles Schwab. Once your account is open, you can search for an S&P 500 index fund or an ETF. Some popular ticker symbols are VU, IVV, or SPY. Many of these platforms allow you to start with as little as $1 and set up automatic monthly investments. This set-it-and-forget-it approach is perfect. It takes the emotion out of investing and ensures you're consistently putting your money to work. The most important step is simply the first one, opening the account and making that initial investment. Don't wait for the perfect time to start, because the best time was yesterday. The second best time is right now. The beauty of the S&P 500 is its simplicity and accessibility. It's a strategy that turns the complex world of investing into a manageable, long-term plan. You're not trying to outsmart the market. You're simply moving with it. By owning a diversified portfolio of the nation's leading companies, you are participating in the engine of economic growth. Through capital appreciation and the incredible power of reinvested dividends, you allow compound interest to do the heavy lifting for you. It's a quiet, patient path to building wealth, but it's one of the most reliable and proven methods available to the everyday person. You are essentially partnering with the best and brightest minds in business and benefiting from their success. To wrap this all up, building wealth doesn't have to be complicated. The S&P 500 offers a straightforward, powerful way to grow your money over the long term. By investing consistently, reinvesting your dividends, and staying patient through market fluctuations, you can leverage the growth of the entire U.S. economy to build a secure financial future. It's not about finding a hidden gem. It's about owning the whole treasure chest. Thank you so much for watching. If you found this video helpful and want to learn more simple strategies for building wealth, make sure to hit that like button and subscribe to the channel. Let me know in the comments if you're already investing in the S&P 500 or if this video inspired you to start. See you in the next one.